3, 2, 1. Sameer Rizvi, you are the CEO of RDCP Care and you are the managing partner of RD Capital Partners.
That's correct.
Welcome to the Care Home Show.
Thank you for having me.
It's an absolute pleasure to see you. So, best place to start. Tell me a little bit about how did you get into the care home sector?
So, all started 4 years ago. I met Irina Dubilovska, my partner at RBS. We always knew about the healthcare sector. We just didn't know what we needed to do to become a part of it. We set up RD Capital Partners, which is a FCA-authorized healthcare-focused investment firm. A year down the line, this is 2016 summer, we set up RDCP Care, which is what we know now, a leading elderly care operator. That's how we got into the sector. Our goal from day one has been to build a dominant presence in the sector. It's a highly fragmented sector, both elderly care and specialist care, and our goal is to consolidate as many of these fragmented groups as we can, go at our own pace and do it as well as we can, prioritizing care.
Mm-hmm. Okay, interesting. And so why healthcare? What was the kind of differentiating factor? Having come from a banking background,
Sure.
I was presuming you would have got exposure to quite a lot of different sectors. What was it about healthcare that was appealing for you?
I think, well, one bit was we were at the end of we still are, we're towards the end of a very long bull cycle. So previous financial crisis, 2008, 11 years on now. So it's a long bull cycle. Brexit was pretty much we've been operating in a Brexit environment since we set up, right? We set up in 2015, Brexit was announced in 2016. So we've been operating in a Brexit environment, and what's one sector that performs well in such an environment? It's healthcare.
Mm-hmm.
Obviously, you dig deeper. What is it within healthcare? It's not the super fancy private side, not necessarily. It's the bit which is heavily linked to the public sector, which is the market where NHS steps in, local authorities step in, clinical commissioning groups step in, and that's where we thrive. Mm-hmm. So it was very much sort of the timing of the business cycle, and we can talk about demographic trends, the aging population, which is a no-brainer. But yeah, it was a culmination of a few of these things that sort of gave us the calling card, which is healthcare. UK healthcare is where you need to be, and this is where we can build a presence at the quickest rate.
Okay,
yeah.
Understood.
Yeah.
And so why is what you do so important to you personally?
I think it comes down to, I might have answered this question differently 3 or 4 years ago, but now it comes down to a fairly critical thing, which is one of the biggest problems that UK healthcare and NHS face is to do with transfer of care. So a person's life expectancy drops significantly if you get the transfer of care bit wrong. So they've had some kind of injury of whatever age this person might be. If you don't quickly get them into the next phase of their care, if that's a slow, dragged out process, that's where the negative impact really occurs on the person's life. So why is it important to me? Because we're trying to build a cohesive, dominant company that operates not just in elderly care but also in specialist care, so we can be the one-stop shop for NHS going forward. So someone ends up in an NHS hospital bed, they get treated over a few days. Where are they going to be for the next 6 months, 12 months? If they're an elderly person, do they need to go to one of our nursing homes? If they're not an elderly person, do they go to, hopefully, one of our specialist care units? So we want to be the go-to people for the NHS long-term partner of the NHS.
Mm-hmm. So it's effectively supporting the NHS in a step-down capacity?
Yeah, absolutely. So if you look at the dependency/acuity scale, you have assisted living facilities, you have luxury care homes, you have nursing homes, you have specialist care, and then you have NHS hospitals. We're just before NHS hospitals, so not luxury, but more dependent than that. That's where we thrive.
Okay. Understood.
Yeah.
So you've kind of touched upon that in a little way in kind of the answering those questions. So before we get in to talk about RD Capital Partners, tell me a little about RDCP Care and how that came about and what that kind of
Sure.
what that journey's looked like for you.
Yeah. So, unlike some big investors in the sector who would come in and buy a massive group and all of a sudden they have a large presence, we started with one. So we acquired Kings Bromley Care Home towards the end of 2016, beginning of 2017. That was our first nursing home. The good thing, and we got lucky partially, the good thing with Kings Bromley is that we acquired it from Embrace Care Group. And when you acquire a business such as this, it comes with a lot of the best practices already in place. So we can obviously overlay our own beliefs on corporate governance and the type of care that we would look to provide and how we manage care excellence. But a lot of the administration side of things, which sometimes can be a difficult process to learn, we acquired, we hired effectively, and that really gave rise to a platform very quickly. So we acquired Kings Bromley. A few months down the line, we acquired St. Nicholas House, and a few months down the line after that, we acquired 4 in Birmingham, which is our latest acquisition around Birmingham.
Sure.
And yeah, biggest one of those is Bearwood Nursing Home, and 3 more.
So you've got, just to make sure, okay, so it's 6 homes as it stands?
Yes.
And what was the, how quickly did you go about from the first acquisition through to the latest acquisition?
So it took
of the
us
4 homes?
24 months from the first to the 6th. So it was fairly quick progression. But yes, 24 months. And the way we know we're doing something right is if you look at our profitability, consistent and rising, and more importantly, if you look at our quality of care, 100% of our nursing homes are rated good or better by the CQC, and in one case, CIW in Wales.
Got it, sure.
And 50% of those have been visits in the last 2 months. So that's how we sleep better at night, knowing that we're doing it right. Yeah.
Sure, got you. So I know a lot of the audience are going to be kind of very care focused. They might not understand the kind of the capital and the investment side of things.
Yep.
Explain for the audience a little bit about how RDCP Care and RD Capital Partners.
Yeah.
How do those two worlds kind of collide?
Sure.
Why does it make sense to operate those two businesses together?
Absolutely. Thank you. So RD Capital Partners is a FC authorized investment firm. So we set up this company first prior to RDCP Care. RD Capital Partners exists to allow us to raise capital for RDCP Care. If there's obviously the healthcare side of things, but if you get into the entire other universe, which is the capital side of things, it can get overly convoluted. We try to keep it simple, but effectively we can structure funds for investors. So it might be a fund structure that we want capital to come in through. It can be a direct investment into RDCP Care. It can be something called a separate managed account for an individual large investor that just wants exposure to the UK healthcare sector. And also means that going beyond RDCP Care 10 years down the line, if we come across another sector that is interesting, it can be another branch of RD Capital Partners. So that's why it's not a parent company. It sits side by side. So legally it's not a parent company, but it is an advisor effectively to RDCP Care.
Okay.
Yeah, and it bridges us from just being a UK-focused healthcare operator to allowing us to become, if we want to, a global financial player.
And is that something that's an aspiration for the future?
It is, and I think it allows us to have conversations that we wouldn't have otherwise. So if we were just RDCP Care, the conversations would be significantly more limited. It's just having RD Capital Partners and having my background and Irina's background on the management team just gives potential investors, whether it's European institutional capital or Middle East family offices, it gives them that much more assurance that these guys will be good guardians of our capital beyond the operations of the business. I think that's being able to understand how to structure an investment, how to best optimize your balance sheet. That can be an equally important driver as ensuring care excellence.
Sure. So I guess you've got, on one side, you've got the FCA regulation from a financial and from an investment perspective, and then you've got the CQC.
Yeah,
as long as those two regulators are both comfortable with the set circumstances, that's a good benchmark.
Yes.
Obviously, what you can do over and above that, that's kind of your special sauce for which is what you're trying to achieve and stuff like that. So, so there are probably going to be people that are kind of sitting there thinking, okay, so this all sounds certain people within care will think that they worry about the fact that the healthcare market's being used as, let's say, an investment tool, and that there's a concern around kind of how that's then balanced against care. I know from our conversations that that's something that you're very, very conscious of. But give us a little bit of an insight into what that looks like for you guys.
So something that I find to be a negative in private equity or any kind of investment firm is the sense of a holding period. So you have a 3 to 5 year holding period. It means you have to enter and exit your investment in usually 5 years. That's not necessarily long enough, and that's not necessarily good enough for the residents, because that's not something that investors always think about. So what we are trying to bring into the sector is what I call permanent capital. What that means is if you're putting your capital behind RDCP Care, via RDCP Care, into a portfolio of nursing homes, that capital should sit there for the foreseeable future. So when we make our investments, and I get a lot of my inspiration from Warren Buffett, when we make our investments, I'm not thinking the way majority of the market thinks, which is, oh, it's a fund structure, I'll roll it over, I'll get a revalue, do a big equity release, all my cash is out, I don't really care. That is toxic, and that's what unfortunately gets reported, and that's the case for a lot of the big nursing home failures, unfortunately. It's not because, partially it's okay, care quality fell, or local authorities reduced funding. That's part of it, but the majority of it is over leverage, overpaying on day one, and just being with the mindset that I'm entering with the plan to exit. I don't necessarily agree with that form of capitalism. I think, especially for healthcare, where you're taking care of a huge amount of human beings, permanent capital is what is needed. We've done that with our existing portfolio. As we expand and we have conversations with institutional investors, that's a recurrent conversation we're having, and folks are on board. People understand the value of that, and on the one side I am thinking about the residents, but on the other side I can understand how to make this appealing to an investor, where they don't have to exit to realize their return. They can realize their return whilst keeping the capital there. There are other more creative ways to do that without ever negatively impacting the residents, or having a care home that has changed hands every 2-3 years.
It sounds like a sustainable approach. You're looking at, because I mean, you mentioned the fact that we're in a bull market at the moment. Heaven only knows we're probably not too far away from being in a bear market. So just to explain some of those things for people that might not know. So a bull market is when the market's going up, a bear market's where it's going down. It's a cyclical cycle, so it happens in a kind of, it goes up and down as such. We're probably not too far away to the tide turning.
All economic pointers say that, we're
in for a hard run.
Yeah, and usually one of the biggest signs, and I think it's tangible in the healthcare sector, is when all capital is going towards fairly expensive, similar type of assets, which in our case, it's luxury care homes. All new capital. I mean, you go to any of these healthcare conferences, there's one thing they're talking about, which is we want to build these fancy 5-star.
And it's going to be £1,600 a week, and it's
£2,000 a week, cost £300,000 per bed, £200,000 to £300,000 per bed to build. I'm looking at this, then I go back to my Excel file, and I talk to the guys, Knight Frank, etc., and we're sitting around, we're like, how are you going to make this work? The moment you don't have a certain amount of occupancy, and even that occupancy needs to be at a very expensive per week rate, it's not a sustainable model. Not only do you not, it's just hard to break even, forget about making a profit. So all new capital is going towards that end of the market, and I think that is a sign of a bad bull cycle.
Sure.
Yeah.
Sure. It's interesting as well. I mean, we've talked about this briefly. We were talking about this briefly the other day when we were catching up, and one of the problems with that from a sector perspective is that's not what wealth distribution looks like in the UK.
Absolutely not.
You've got people who can afford to pay for their own care, but for most people, the prospect of paying much more than £1,000 is almost inconceivable. £2,000 is it's just a kind of a completely different planet, and it makes up such a small proportion of the population of the UK. Granted, if you can operate a model that works and things, then great, but it's not an accurate representation of, again, what the sector looks like as a whole. It doesn't.
Spot on. Yeah.
It's not. I guess it's not kind of from macro view, it doesn't support everyone.
No, I mean, which is why when we think about what we're doing, it gives me a lot more comfort, because economically, financially, it's sound, because we're going after, and we're trying to cater for the backbone of the UK economy, or any developed country economy, which is the middle class. Middle class is huge.
Mm-hmm.
And they can only afford a certain type of care. A lot of that is linked to the NHS, both definitely on the elderly care side, and especially on the specialist care side. And for investors to not realize that, but only just focus on, no, but I want to put my money there because a piece of real estate looks of a higher quality than the ones you're focusing on.
Mm-hmm.
That just is, that is illogical, effectively.
Mm-hmm.
And I feel fairly strongly about that. So yeah, we RDCP Care and RD Capital Partners, our focus is to become a leader in the mid-market, what I call mid-market UK healthcare market, which is the middle class, which is, yes, some folks can pay private, but the private fees are £700, £800, £900 a week. But the other half is funded by local authority, NHS. They're not going away. We are a welfare state. It's just about working with the government to find the right solution going forward. It's not about backing off. And secondly, as we talked about the business cycle, a recession is forthcoming. The moment that happens, folks will lose their jobs in the city. They will not be able to pay for their mother or father's extremely expensive care. That happens, they have to move care homes to the mid-market level. And that's when the top end will start to collapse. And maybe they will sell for prices that make sense to me now. But I see it as a sign of trouble, actually, yeah.
I've been saying this for a little while. Not that I have that many conversations in a care context, in the care sector context, about kind of things economically. But those are the people that know me well have been talking about this for a while. So it will be interesting to see how it pans out. But it has been my feeling for a while that, similarly to yourself, that all the telltale signs are there. It's just kind of a case of how long and how deep.
And UK might lead it, thanks to Brexit, right? We have we're exposed to the same things as the US or Canada or Europe, but we also have Brexit. So we might be the leader in recession and leading the start of the bear market. So we just got to be ready. The goal is to be ready for when that happens.
Absolutely. It depends on whether it's us being led by Brexit, or whether it's Deutsche Bank potentially, because those guys are in an interesting set of circumstances as well.
Right.
But
it could be one big financial player that has brutes everywhere in Europe taking down. It usually is one trigger where something bad happens, and one after the other, starts with the big hedge funds, starts with guys like Woodford, just selling. And when that happens, it follows through. It hopefully will be managed. It might be a slow process, but the point is, we as investors, or myself as an investor, just need to be ready for when that happens. And the portfolio needs to look as such that it can survive that 2 to 3 or 4 year period. And hence why we're raising capital, because you want to have dry powder when shit hits the fan, because that's when you can pick up these. I would love to own one of these fancy care homes, just at a price that makes me happy, not the other guy happy. So it's about it. Sometimes it comes down to that, and then we can maybe offer that to the middle class, and that's good for everyone. And
I guess that comes back to your point around you're making sure that you understand the economical impacts of the markets that we're likely to experience, and then building in the economics, basically making sure that the fundamentals of care and that the business is sustainable, but it's supported by sensible investments, rather than taking a short-term 3, 5, maybe 7-year maximum investment cycle where you've just got some private equity house saying, I need a 20% IRR, internal rate of return. As opposed to saying, right, this is a long-term view, we need to serve you for the foreseeable future. Absolutely. Sure. Okay. No, that's interesting. Thank you for explaining that. Of course. It's good to. I guess you've got a quite unique background of the fact that you come from banking into healthcare, looking specifically at elderly and specialist care. Being able to balance those two worlds effectively, I think, will play out for you well in the long term. So all power to you. I can imagine it's going to go well. I mean, it's gone pretty well for you so far. So yeah, good work so far, and long may it continue. So one of the things that I'm fascinated with, relevant to what you're up to in the world, when we first met, and it was probably 18 months ago, 2 years maybe?
I think 2 years, a little over 2 years, yeah.
Got to be something like that, hasn't it? And I remember, again, both of us were relatively early on in our kind of care sector journey, if you like. But I can remember you talking very passionately about the quality of care that you wanted to be able to deliver and the standards that you wanted to be able to uphold. Tell me a bit about that, because I get the impression that there's we haven't talked about it recently, but you will have had lots of learnings. Your original kind of benchmark of what you wanted to achieve has started to kind of come to fruition. What's that all look like?
Yeah. So for us, and I think for any long-term successful operator, especially one that's trying to grow aggressively, the one thing that needs to be, that you need to get right and that needs to be prioritized and always at the back of your mind is care excellence. It's not just care quality assurance, it's care excellence. And in our case, that means care excellence without all the gimmicks. So what that means is quality of care is top notch. So I think I was mentioning this to you earlier, but 100% of our care homes are good or better. 50% of those were visited in the last 3 months and still got good or better. And it's reflected in that. Also comes down to transparency, where the regulator wants it. I want it as the director. Should something happen, how do you manage that? It needs to be reported, and a safeguard needs to be raised appropriately. That is part of it. So care excellence and total transparency, complete transparency. I think these two things create for an environment where the residents are happy, most importantly, the relatives are happy, the employees are happy, and we as directors and shareholders are even happier. Once you have that, you know that you're doing something right. You know that the free cash flow that the business is generating should be invested not only into the business, but into more opportunities, because you know what you're doing makes sense. And then you can take that same model and present it to outside investors who want to get a piece of the sector, but don't want to get into the operations the way we do. But all that sounds great, but again, comes back down to care excellence and transparency, and that is part of our ethos at RDCP Care. It's just no gimmicks, but get it right. Get it right. Do more than what's necessary. Should a report have recommendations, action them straight away. That's been our priority. If there's a deal in the pipeline, an acquisition requires capital, but in the meantime we have a CQC audit, they're happy, everything is good, but hey, you could do with a few memory boxes or whatever it may be, need some more outside furniture, that needs to be priority number one always. And it's a basic, simple rule. It never needs to be too complicated. There's no 10-step process. It is simple, and it is about the principles rather than about case by case, how do we handle this? And I think if you get the principles right, the rest falls into place.
So care excellence, break down a little bit more about what that looks like for you personally, because it's quite, to a certain extent, it's quite subjective, and what people will look to try and do is to kind of embed. You mentioned the word ethos, trying to embed their version, what their benchmark of excellent care is, or outstanding, or whatever it is specifically that you're aiming for. What does that look for you guys?
For us, it's, again, back to principles. It is really simple. It's just that any member of the team, so whether it's a domestic worker, a carer, service manager, regional manager, us, operations director, whoever it may be, rule number one is the resident and their relatives need to be happy. Just, they need to be happy, and they need to be happy in a care context too. So the way we do care planning, the way we do reporting, the way we record things, whether it's electronic or not, it just needs to be done with in mind, what if the husband of the relative was looking at this, the resident was looking at this, or what if the wife of the resident was looking at this? Would they be happy with the way the care is being provided? Or if you were in this person's shoes, would you be happy? Would you live in this bed? I think that's what it comes down to. Having that at the back of your mind as a principle overarching the entire company, everything else falls into place. I think it's about that big picture sort of approach, which is just focus, put yourself in the shoes of the resident.
Okay, understood. So I know that you've got a strong vision for the group. Break that down for me. Explain to me what that looks like for both organisations, because I think that's important.
Sure, absolutely. So RDCP Care to date, what we've done is we've built a leading presence in the Midlands. Midlands doing elderly care. More specifically, we're doing nursing and dementia care in the Midlands. That's just how our portfolio has evolved. We acquired one and we grew around that area. That's been what I call Fund 1. So our first fund, which is just capital from myself, Irina, and some family and friends, where Irina and I are the only shareholders and directors, that's been the focal point, which is build as quickly as possible and as sustainably as possible a presence in the elderly care space. Specialist care has much higher barriers to entry. Starting from scratch and doing that is, in my opinion, harder. And acquiring those businesses without keeping the principles in place, when the directors leave, it is a little bit harder. So what we've done was probably the path of least resistance, in my opinion. We've done that well. We wanted to get to a certain critical mass. Our portfolio is now has an enterprise value of roughly £30 million. So we wanted to get to a decent enough size that people will pick up the phone. We're now at the point where we want to take it one step further. So we've done this in 3 to 4 years. The question is, what do we do in the next 3 to 4 years? And the goal now is to really build a dominant presence. So right now we have a presence. Now it's to build a dominant presence in both elderly care and specialist care.
Mm-hmm. And what do you feel that looks like specifically for you over the coming years?
That means we have a fairly chunky deal pipeline. So we're working on we're working on 2 acquisitions right now, 2 groups of 2, both around the Midlands. So these are, should they complete in the next few months, they'll still be part of the existing portfolio. That'll get us to 10 nursing homes, 405 residents, and that's a £50 million business. That's a goal we want to achieve as quickly as we can. But beyond that, how do we get to serious market share? That's when institutional capital comes in. So there's only so much we can do by reinvesting free cash flow. We do need institutional capital, and that's where RD Capital Partners steps in as an FC authorized investment firm, and we're raising Fund 2 as we speak. Mm-hmm. So we're raising a £50 million Fund 2, so that's £50 million worth of equity. And the remit for that fund is to continue growing our presence in elderly care whilst building out a presence in specialist care. That's the focus of Fund 2.
Sure.
And we launched that in May, and we're just having conversations, building out data rooms for specific investors, and just working on that.
Sure. So obviously that's kind of a size and scale volume.
Yeah.
What else kind of sits within that? That seems like quite a kind of an investor focused perspective from a care business perspective. Like, what do you want to achieve within the from the perspective of the actual care itself?
Sure. I think the goal for us would be to have one company that the NHS can rely on. So one company for effectively all types of care that is not an NHS hospital bed. Mm-hmm. That's the way we think about it. So, like I said before, so it could be a person who's late 50s, they have some kind of injury, acquired brain injury, they go for immediate relief at an NHS hospital. Following that, they need 6 months of bed care, 1-to-1 care, 2-to-1 care. We want to be able to offer that. Now that person knows RDCP Care. When they are ready, we want that person to come back to us into one of our nursing homes. Again, same would apply for same situation, but it's a much older person. They immediately go to one of our specialist care clinics for 6 to 9 months care. Then for long-term care, they transfer to one of our nursing homes or residential care homes, whatever it may be. But the goal is for RDCP Care to become the trusted partner for NHS long-term. Mm-hmm. And to be able to offer care at affordable prices for everyone. That's really the goal.
It's a big vision.
Yeah, absolutely. I think, honestly, it's a big vision, right? especially, I could have stopped at, we're going from 6 to 10. But I read this book, the 10X by Grant Cardone.
Okay.
And he really talks about if you don't have that 10X, if you're not taking massive action, he uses the word massive action. If you're not taking massive action, it's hard to achieve even the smaller steps. So I might have this massive vision, but even if we achieve 20, 30, 40% of that, we've done pretty well. Mm-hmm. So, but to motivate ourselves and for the team, the management team, just to know what are we working towards long term and medium term, that's the vision.
Mm. That makes sense.
Yeah.
That makes sense. And from the perspective of supporting the NHS, there's a lot of support that needs to be provided.
Yeah.
I guess one of the challenges within that, of course, is the ever difficult engagement between private and the public sector.
Yeah.
Of course, that's something that I'm sure that you will spend an awful lot of time thinking about and working out how kind of your model can best serve that.
Yeah.
It's that's not going to be easy. I'm sure you know that anyway.
No, it's not easy. No, absolutely not.
But that's because that's your model, because that's your focus, I'm sure you will be putting a huge amount of time and energy into making sure that you've got a service that can best fit the needs of the NHS to support. Have you done any research around, so if you're looking to be able to try and do that, surely there's, by having that best service for the NHS, surely there's cost savings for the NHS by having that.
Yeah, of course.
For you, have you
Absolutely.
had an opportunity to kind of quantify what that might look like either kind of now or in the future?
I cannot give you a figure, but I do know the transfer of care side of things. That is honestly, that's one of, I think, NHS list their top 3 problems. That's one of the biggest problems. So if there is a company that is actively working, and hopefully that's us, to solve or even partially solve that problem, that's a huge plus. That time that they spend where they're going into their platforms, talking to various specialist care and nursing home providers about what to do with this person, this resident. In that time period, that person is there, and every single additional day, it's costing them on a weekly basis several thousand pounds per week. Several thousand pounds, which is why they will pay several thousand pounds for them to be in one of your specialist care beds. So there is a massive cost saving for the NHS, and I think it's just better use of taxpayer money in general. And then we as a business know we're helping both the public sector, but also doing good for ourselves and our shareholders and our residents. So it's a win-win for everyone. That's how we see it.
Doing that on scale again, I'll be so interested just to kind of see how that works, because I know a lot of people have made an effort to do that to some extent. But again, you know that's not necessarily going to be an easy thing to go and achieve.
I think if you want me to talk a little bit about that, about what because we focus a lot on that. People have tried this, right? People have tried, especially in elderly care. They've tried scale in elderly care. Not necessarily. They will dabble into specialist care, but not necessarily. So I've seen 1 or 2 mid-sized operators that are doing both, but none of the HC1 type guys are doing both well or at all. So one mistake that I've seen the larger players do or large investors do is they will overpay. They will overpay to acquire a decent sized group. To overpay, they over leverage, and then it's just it falls on from there. So they've over leveraged, their cost of capital is too high. They start to compromise care quality by cost cutting.
Just to explain that again, so over leveraging, you're talking about putting too much debt in a business.
Yes. So again, it's such a simple thing, but people don't think about it. Is if you agree to overpay, so this is step 1 of the conversation here. You're negotiating with a seller. You agree to overpay for whatever reason. That is the start of a very bad cycle for you, in my opinion, because you agree to overpay. You need to borrow partially, unless you're funding it all equity. You need to borrow partially for that. And if you're overpaying, you're overborrowing, hence over-leveraging. Unlike equity, debt needs to be paid back to the bank or to a syndicate of banks. And that has a detriment on your P&L, and that has a detriment on your residents. So I like to think something that we bring to the table as a company is we're aware of that. We're coming in heavily aware of that. What went wrong with Southern Cross? What went wrong with Four Seasons? And we try to take the best practices of care excellence from operators in the market. We put those two together, and I think that's what's going to help us be a permanent company for the long term in UK healthcare. But yeah, one of our focal points is do not overpay, no matter how good it sounds or how much the broker convinces you. I think that's important. It's so basic, but it is super important. Yeah.
Yeah, probably quite a lot of people have been stung by that for in various different sets of circumstances. Yeah. It's interesting because I think Four Seasons is up for 400 million, at the moment, which is
peanuts.
Less than half that it was before. But for somebody to buy that, for it to be an attractive offer, it needs to be smaller. It needs to be it needs to be funded. It needs to be structured properly, and if it's not, then obviously it's just going to be the same old.
Which is why it's such an interesting time to be in UK healthcare, because Barchester's for sale. Unfortunately, that fell through. Macquarie pulled out. Four Seasons is for sale. Care UK is for sale. HC1 is for sale, and these are the 4 or 5 biggest guys. Then you have all the way down in the 5 million to 25 million pound range. A lot of groups for sale. That's just normal sort of mergers and acquisitions in the sector. But because of Brexit, buyers are either holding back or not stepping in, and that just means for guys like us who are fully behind the sector, it is a good time to be investing. Yeah,
it'll be interesting as well. So when we do enter into a downward market, it will be interesting to see what impact that has on the sector. Hopefully that positions you in a way where you will have an opportunity to be able to make good quality acquisitions and to better support the residents, because there's probably a disconnect in quite a few people's minds, again, if you don't understand kind of the economics of the situation, to see that there's a direct connection, as you've just explained there, between the cost of a care home and its kind of financial engineering relevant to its sustainability, because if the business is if the business is generating, even if it's generating good money, if it's having to pay all that money back to the bank because the cost was too high in the first place, then that money can't then be reinvested back into the training of the team, the environment for the residents, all the important stuff that is absolutely essential to high quality care provision.
You're absolutely right. There is a disconnect, and if you bring those two together, you realize a few basic principles or a few basic steps that you can follow on day one can have ultimately better impact on a person who's in one of your beds. He or she's going to have a better life because of that day one decision, and it's hard to think like that. But we try to think like that, and that's been our
understanding both of those two worlds. And where otherwise there might be a disconnect, it's kind of bringing those two places together and being able to say, right, okay, so this is what's happening here, this is what needs to happen here. How can we balance that in between those two worlds? Which is, again, it's an interesting, because you straddle those two worlds. It must be,
I think it's our strength.
Fascinating.
It is fascinating, but it's our strength.
That's what I was going to say, because you've done it and you've done it successfully, and the model seems to be working and things like that. It certainly seems to be something that's what we talk about. So our vision as an organisation is that sustainable care home businesses provide the best possible life experience for everyone that lives in, that works for, and that owns a care home business or group.
Spot on.
Everything that we do contributes towards making that happen. But for you guys, you're making sure that the sustainability side of things works from an investment side of things as well, and making sure that it's also appealing for investors, because they get the vision that you have, the long-term vision, trying to make sure that it is sustainable. Therefore, serving all parties that are involved.
But the three things you said, spot on, and add that final layer of strong balance sheet, smart balance sheet, and that's all you need. Honestly, that is all you need. I realize maybe in healthcare, but definitely in finance, people try to overcomplicate things. They use big words. They use fancy words from corporate finance books. It's not what you need. It's simple, man. It is simple. Just don't overpay. Focus on care excellence. That's it. That is it. Having nice simple rules of thumb to live by are worthwhile. It becomes difficult. It becomes kind of distorted. Otherwise, you become pulled from pillar to post because you don't have kind of like a clear operating model. Which is a pretty good segue to what I wanted to talk about next. So I
my team and I spend an awful lot of time with operators, helping them build out their operating model, and that's not the structure for the business, kind of the systems, if you like. That's the cultural operating model,
right.
So, or their cultural assets, so the vision for the business, the values of the business, etc. I know that explain to the audience, tell me about your values as an organisation, because I know that's something that's really important to you.
Yeah. I would say our single most important value, and I have touched on this, so I'm sorry if I repeat myself, but our single most important value as a company, and it can mean many things to different stakeholders, but the single most important value is transparency. And I think in today's world, that's A, very important, and B, if you try to fight it, you're just going to look stupid. So transparency is key, and like I said, it can mean numerous things to various stakeholders, but probably the most important bit is transparency with how care provision is happening in one of your homes. Transparency around that. So if an incident occurs, the goal number one is make it zero. Don't let incidents occur. However, should one of those incidents occur, what are the steps that the team there are supposed to follow straight away to minimize any negative impact from said incident? That is key. And I think that is what the CQC wants, but that's also what I want for the business, because that just reduces risks significantly.
Mm-hmm. We were talking about this before, weren't we?
Yep.
And it's an analogy that I use quite regularly, but if you've got like a two-sided Venn diagram,
right,
and on one side you've got what you do in your business and then your reputation,
yep,
people are going to see and feel and experience what you do in your business, and that's going to be your brand and your reputation.
Yep.
By being transparent, ultimately people are going to see that you're honest and that you're straightforward people, and that you're I guess the opposite of that would be to be kind of insular and to try and cover things up. And there's just no way that you can get away with doing that. And when it does happen, that's usually when incidents of abuse or significant safeguardings either happen too often, or they're being covered up, or it's just a whole melee.
That's what they hate. If you're covering things up, they as in the regulator, the government, that is what is to be avoided. As a sector. So transparency is our biggest value. On the other end, that also means for our investors, they're fully aware of, and for our bank, they're fully aware of the ongoings of the business, of the financials. We don't try to hide anything of our growth plans. Our vision is very open and honest. People know what we're trying to do. We're not, sometimes, as you say, it is a big vision for a 6 care home group, but we don't see ourselves as a 6 care home group. We see ourselves as RDCP, which has, yes, a £30 million portfolio, but it has a pipeline of something significantly, of a whole level of magnitude, or 2 levels of magnitude higher. So just, transparency is probably, if I had to give one single most important value for our business, it's transparency. And that's been helpful from day one. So I've seen with other groups where the director is too scared to share with their senior non-shareholder personnel the plans for the business. They don't want to scare them. That's not our case. It keeps them motivated. It helps us with employee retention. People want to stay with us because they know they've seen a deputy manager become regional manager in a short period of time. That is what motivates a young nurse to see, actually, if I stay here, this company is on a rocket ship. If I stay here, I'm going to progress both in income and stature much quicker than I would anywhere else if I'm jumping around between various companies. So we try to, part of that is transparency, being able to, hey, what are you guys doing for the rest of the year? Well, we're trying to buy this, we're raising a fund, which a lot of people don't want to share because, they might get scared, why are we growing quickly? But if you mention what the goal is, what the plan is, why we're growing, that helps everyone.
I think starting with why is very, very important.
Yes.
If people get the why, you can talk about the what and the how of whatever set of circumstances is he's talking about. If people understand why you're doing something, they've got far more likelihood of being able to buy in, because usually the why of any situation is how someone can emotionally connect to what that
Correct.
can mean for
Correct.
their team and for them personally, and what
Correct.
that might mean for their family.
Yeah.
And it creates a feeling of inclusion.
Yep.
Because if people know that, we've got these really aspirational entrepreneurial owners that are looking to try and create something fantastic, either people are going to be super engaged by that and they're going to think this is fantastic because we want to be part of the journey, or on the flip side, some people might say, actually, you know what, that's not
for me. Yeah.
And those team members might be absolutely perfect elsewhere, but they're not going to be right for you, which means you get a far more cohesive team because you've got people who are up for the vision, for the journey to help you achieve what it is you're looking to achieve accumulatively, and they're going to get excited by the journey itself.
So. No, you're spot on. And our why really is we see a fragmented and sometimes broken sector, over-leveraged balance sheets where things are slow, they don't know how to turn it around. And it's honestly, sometimes, 4 seasons, it's not possible to turn around. You just need to sell it to someone else who needs to clean out the balance sheet, i.e. cash-free, debt-free, change the balance sheet altogether. That's what we're trying to do. We're trying to clean up the sector, enter at a stable state from which the sector can grow, and the focus can then be on the residents. It doesn't need all this huge news about things changing hands every other week. It can have a stable presence. It can be the private healthcare sector can be nicely partnered with the NHS, and we can continue to just focus on residents. And that's our why. Yeah.
It's an important why to have.
Yeah.
It's an important why to have for sure. So, you when we first met, again, albeit 18 months, 2 years ago, whatever it might be, I think we connected on the fact that we're both quite entrepreneurial people, and we're both got quite big aspirations and things. And what I recognised you in the fact that I believe that you're quite a high performance individual, in the fact that you're coming with great vigour, you come with great aspirations, you've achieved everything that you told me you were going to achieve 2 years ago, you've achieved, which is awesome.
Thank you.
And it's very, very exciting. So for you personally, what does high performance mean?
Do you mean that in the context of the company, me personally?
Let's
both
unpack it from whichever direction you plan to think's most important.
I think for a company, and this might not be true in healthcare, but this is a problem that is a big problem in capitalism right now, which is that somehow companies find it okay to not be profitable. We're just going to fund growth from outside capital. Guys like Deliveroo, if you look at any of these look at the business model, or even Uber, I'm using big name examples, but if you look at if you just spend 10 minutes, you realize they're never going to be able to make this an independent company which doesn't need outside capital to fund revenue.
It's this concept of that's been kind of popularized by Silicon Valley to a large extent, isn't it? It's all mass equity raising. This is kind of this virtuous cycle.
And the only way it works is if person A sells it to person B at a higher price, and then that guy sells it to the person C at a higher price. That's the only way it works. And what does that mean? This company, this thing that you're playing around with, which has human beings involved, ends up with this stupid valuation. How is that valuation funded? With a lot of debt. It's the same problem. So for me, high performance means you have this silo, which is a company, and you're able to run it profitably, you're able to run it well, and that money can then get invested back into the residents in a care context, back into the employees, and then the remaining free cash flow can be used for growth. I think that is high performance. That way you can be independent. You don't need to have this crazy set of investors who are shouting down the phone, we need growth because we gave you at this high valuation. You need to grow the valuation further. You forget what the purpose was on day one. So that is high performance, is being able to run a company without the need for all this outside support. It's almost like a cycle without the training wheels.
Sure.
So it's what, maybe not healthcare, because healthcare is not quite venture capital, at least not elderly care, but it's a global problem of capitalism that started probably in the 90s, and it's really become a major issue now, is these companies that think it's okay to just effectively not make money. It's like a hobby.
It does seem to be more and more prevalent now. It'll be interesting to see something something bad will probably end up happening, and people will maybe or maybe not. They'll realise that it's not so much of a good idea to operate like that. Let's just wait and see again. With the bear market around the corner, it might be this might be a set of circumstances where people start thinking, actually, you know what, we probably should have made some money because this doesn't seem to work particularly well in a downward market. So we shall see.
But we're humans. We're creative. Capitalism is its own thing, right? It's an organism. It becomes what it becomes. So it's about just being aware that it's its own moving parts, and just as an investor or as a stakeholder in this ecosystem, how do you best shelter yourself and the people who rely on you to shelter them? I think it's important to have that approach and thinking.
Again, you're very good at summarising things kind of simplistically and just having kind of a straightforward rule of thumb.
I appreciate that.
I like the definition of high performance. So I appreciate that. That's a good one. So tell me, how about you, for you personally? What does that mean for kind of how you show up in the world?
For me personally, high performance. I think most recently for me it's been, I have learned that in order to grow at the rates that I desire, I need to take a lot of action. So if I'm only pursuing a few things, whether it's transactions or it's, I'm just going to continue growing this way and not focus on the fund, or I'm just going to focus on the fund and stop growing organically the way we've done to date, it just puts too much pressure on the fund, or it puts too much pressure on one particular transaction. So I made that mistake in the past. We had one transaction going. If it failed, we would not reach our target, and I wouldn't be here speaking to you. And that's unnecessary. So I've learned sometimes it's a cost thing, right? The more deals you have, the more legal fees you have. So it is about, you can't just be, and then the brokers lose trust in you if you're saying, no, I'll buy that, but you can't. So it's just about managing that. But I have learned, and you're doing it. You're probably one of the best examples. You're taking massive action. You're not just doing one thing. And that way, this thing right here will get you non-executive director positions, right? It can get you called up on Bloomberg. You don't know. But the point is, you're out here, you're hustling. I think that's what's required. That's high performance to me. Is, you have one thing that works well. I can just keep buying a care home here and there. Bread and butter, cookie cutter approach. That's when that doesn't work. I've seen. I think you need a lot of action, and you do the same.
Thank you very much, sir. Appreciate it. So is it, if you by having that kind of constant cycle of stuff that you're focusing on to strive, I guess it's stopping you from becoming stagnant in any way, shape, or form, because you don't have that next goal, that next opportunity for you to grow personally, and then what you have to learn in the process of achieving whatever it is you're looking to achieve. Then people say if you're not moving forwards, you're going backwards.
Honestly,
I think it's that type of a thought process.
I agree. It's also important not to, and I think Irina helps me sometimes with that, is it's important to make sure it is still focused, so it's not, hey, I'm doing healthcare, let me also try something else. Not necessarily in that way, but in your case, SP&P, but also, let me get this podcast, YouTube channel off the ground. I think it's about that. So for in our case, let's continue growing our portfolio as we can. Deals that we can afford to do, let's do them, because they're in our region. They're in the Midlands. We'll continue to grow. It still meets our long-term vision, but hey, we need to do the fund because we need to get outside investors. We want that cash, dry powder for when potentially a recession happens, and there's a lot of beautiful groups at bargain prices. We want to be there ready, because that's a hard time to raise capital. But if you already have capital, that's a great time to deploy. So it's being able to do as many things as possible within what's considered reasonable, and
that comes back to that comes back to what you said your major strength was, your understanding of the care market, but then also the investment cycles and everything.
I think it helps.
Bridging those two
gaps
enables you to be able to go and do that. So I don't think I've ever asked you this question before. Were you in any type of leadership role when you were in banking, or is this kind of the first effectively kind of leadership position that you've held?
It wasn't a meaningful leadership role in banking, so this is really
probably this is the real deal for you.
Yeah, okay. Absolutely.
So within that then, and then this is something that we share effectively, because I'd done kind of like supporting other team members in some of the other roles that I had, but it definitely wasn't this type of role. Effectively, I don't know what your experience is, but I thought to myself, wouldn't it be great to started a business, and then thought, oh shit, I've now got to lead people. So
it was scary at the beginning, I won't lie.
100%. But you've done a great job in doing what you're doing. In your experience, what have been your greatest leadership lessons?
For me, I think one thing that I try to show to my team, and it's very effective, is I want to be the hardest worker in the company. So we have 280 employees, which you tend to if you own care homes. It's a heavily labor-intensive business. So 6 nursing homes, 280 employees. It's still being the hardest worker. So as we start to grow, we could have hired straight away. We could have hired a bookkeeper, accountant, who would take a lot of load off of us, but we chose not to do that because A, keeps us close to the business, B, chose to our team members who are working hard in the care homes that actually these guys are not just shareholders, but they're constantly they're working, they're constantly either A, trying to grow the business, or B, trying to manage it. So for me, probably one of the biggest leadership takeaways or recommendations, however you word it, is still be the hardest worker, because that just motivates people to step up their game in your team. I would recommend that. Don't take the foot off the pedal the moment you've had some minor success, basically.
Again, that comes back to the thing that you mentioned earlier around making sure that you've got that next goal teed up and ready, so that you know you've never got that opportunity to be stagnant. People are going to see you continuing to strive for success. I think there's a learning in what you said earlier around being really, really close to the business, and the fact that you effectively did bookkeeping, which, I mean, you can buy that type of a service for a relatively small amount of money. What that shows also, as well, is the fact that you're not willing to roll up your sleeves and just get involved in the stuff. I mean, would you necessarily get involved in day-to-day care delivery? That's not necessarily your skill set, but
I would,
but because you understand.
Like I said, our nursing homes are in the Midlands. Our RD Capital Partners head office is in London, and I live in Surrey. So I only go there maybe once every other week, and I spend a couple of days. So, but when I'm there, and I'm getting involved as much as I can, without stepping on any toes. But if I were living, maybe we will expand to care homes in Surrey or in London, and I hope we do. It would be a pleasure for me to be there as often as I can. And
have you seen? There's a chap called Andrew Cannon. I can't remember. He's one of the CEOs of one of the big groups. Basically, every single year he does an inspiration for me, actually. He did every year he does a week as a carer.
That's amazing. I would do that.
This is a big old group, and I mean, bless him. Like, he'll do. He does these little videos where he just does kind of a little snippet, and he explains what he's learned and stuff. And in a very different way to it being hard being a CEO role, but he talks about real life experiences and being able to shows real humility. I think to do that.
I think what's needed. I would do that. That's a great idea. I will take up that challenge.
Tell you what, if you do it, we'll come and do some shifts together at some point or another. Deal, promise.
Done. Honestly, I think that's a lovely idea. Let's do that.
I think it'd be fun. There'd be a massive learning curve as well for both of us. You get to see it so often, but getting involved.
No, it's one thing to see it. It's one thing to be at the desk, but it's another thing to be on the.
We've got video evidence of this, of course, now. So it's
people
this is happening.
I will share this with the entire company. So they will hold this. If they make it this far in the interview, they'll hold it.
We're getting hold of it. That's cool. Well, I look forward to it. That'll be good fun, and we'll tee that up in the future. So, a couple of questions just before we wrap things up. So, what's the best piece of advice that you've ever received?
It's a funny one. You told me you would ask me this question, so I thought about it. I was thinking of, big name. I was thinking Warren Buffett. I was thinking big guys. But the funniest thing is, Irina, my partner, her late father told her, and he used to own a small engineering business in Algeria, and he told her that because she wanted to get into investment banking. She thought she wants to work for big corporations, etc. And as she was going off to uni, he told her, listen, it's significantly better and more fulfilling to work for yourself, even if it's a much smaller company, than it is to work for a big corporation doing what they tell you and you know, collecting a salary. And that's probably the best piece of advice I would give to anyone. Maybe not my own staff members, but I would pass that on to, I think that's been definitely the case. And probably for the first year when we left banking, we were making less than we were in banking. But then it's your own project, right? It's your own company. You can take it as far as it goes. So it's significantly more fulfilling. And I wouldn't be sitting here with you if I was still at RBS, right? You wouldn't know me. Sure. You wouldn't care. So, yeah.
It's interesting as well. I mean, you say that maybe that wouldn't be applicable to your team, but because you've created an entrepreneurial environment, it wouldn't be surprising if, because people have seen you as an inspiration and thought, actually, you know what, this has been almost like, what do they call them, like the incubation hubs, like where you're in an environment where being open-minded and being a bit more free-thinking is kind of the standard and the norm. You may well inspire people to think, actually, you know what, I could go and set up my own business and stuff like that.
Absolutely.
Knowing the type of person you are, I'm sure you'd be delighted by that. So.
Yeah, I mean, we do give our senior staff members a lot of freedom. So, you know, they have ideas of, look, this particular care home, one of our 6 is doing well, but it could do better if we started doing specialist care for elderly on one side of it, and they have the go ahead. They run that project. So we try to create as much as we can of an entrepreneurial culture within healthcare in our company. But yeah, I appreciate that.
And lastly, so if you were to give one piece of advice to somebody looking to try and make a positive impact in the care sector, what would that be?
It probably goes back to what I said earlier, which is if you're entering, similar to the way we did, and the best way to enter is to buy one of the group's entrepreneurs retiring or groups exiting, just do not overpay, because that will determine your next 5 years. So if you don't overpay, you have more cash flow left to give back to the residents, do more capital expenditure, improving the facilities, and invest in the employees' training, employees' sort of retreats. So do not overpay, because if you get in at a good price, everything else will fall into place. Once that is all in place, never forget to prioritize care excellence. You get that right, everything else will be fine.
And that seems like a perfect note on which to wrap the episode with. So, Sameer, it's been an absolute pleasure. Thank you so much for your time.
Thank you for having me.
My pleasure.